The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we wrapped up the holiday week of trading on Friday, we saw plenty of red across the commodity screen in the grain trade, especially with the soy complex under a second day in a row of some pressure. KC wheat as well under pressure. Corn couldn't hold the gains from Thursday. Meantime, though, a good day in cattle. Hogs a little lower, so it wasn't all a bad day, but still plenty of things to kind of digest, and we got to refocus a little bit here in the trade. Joining us now on Market Talk, it's the first time he's been on the show with us. We're happy to have him here, Jim Emter with Van On and Company. Jim, it is great to talk to you. How are you doing?
Jesse, doing well here. You know, weather's been a little cooler, a little calmer. Fourth is beyond us, and now we come in here to some pretty extreme volatility as we work through July and August. But pleasure being on the show for the first time, filling in here for Christy here today, and like I said, appreciate the opportunity.
Yeah, I'm happy to have you on with us here today as well. And you mentioned that volatility. Man, oh man, I made the comment to you before we jumped on the air how the week of the 4th of July, when it's in the middle of the week, just makes things kind of weird. It just felt like the trade, didn't know, the right hand didn't know what the left hand was doing, so to speak here, especially in the grain markets throughout this whole week, Jim.
Well, I think we've got to look at that and check that. I think a lot of people, when you throw that holiday on a Tuesday or Wednesday or Thursday, there's a lot of people that take this week off. And anymore with the technology we have, people are still trading, don't get me wrong. But again, as to the calls to the clients and what's occurring, we're trying to do our best to make sure all clients are aware and doing what they need to do through that. But I think there's people, investors, funds that take a little bit of a back seat here and say, hey, we'll check this thing back out on Monday and ultimately take on that direction. Now, we're seeing okay volume through the stretch. So I want to be careful saying we're checking into a holiday trade. But in the same degree, I don't think you have all your market participants. And especially when we follow a June 30th report, the dynamics were set in that report. Those dynamics have not changed greatly. What has changed is we've continued to reiterate a forecast that is semi-favorable, at least for this period of time that we've got. So when you look to it, we've got generally cooler temperatures. We've got general rainfall that's occurring from what I'll say southern Minnesota south. We've got Wisconsin, Minnesota, North Dakota, South Dakota that I think would really prefer a drink of water here. But again, have been under okay circumstances, knowing that we've gotten some rain here recently. So those dynamics alone are warrant enough to bring some pressure to the markets. But when you do it this big, I think it just catches people to take a step back and say, what's happened? Let's not forget, we're a market of movement right now. And I think we've just got to be okay with that. Know that the volatility, in my opinion, is here to stay for another month and a half, and try to read between the lines as we work ahead.
You mentioned a couple things there that I want to dive into a little bit more. And I think just in general, and I made this comment a couple times here this past week on the show, it felt like those June 30th reports with the extreme surprises that we saw there. You have that. Then through the 4th of July, it almost feels like the market is trying to grasp the correct value for corn, beans, and wheat now, and trying to almost kind of just reassess and rebalance things here as we get into the month of July. Take the weather out of the equation for a second, everything else. It just feels like we're just trying to find that value. What is a fair value for, say, December corn, November beans, et cetera, Jim?
And I think that's a fair expectation. So let's kind of dissect that and piece that apart, Jesse, because I think you're going down the right rabbit trail to really break this apart. As you look to the corn market here, we know that USDA has been consistent at $4.90 to this point on their fair market value for corn. So lo and behold, where are we closing here today on a Friday? $4.94. That's where Deese is hovering around right now. So that shouldn't be a shock when you see a big increase in acreage. You see yield variations and expectations that are across the spectrum right now. I'd say there's a lot of people between 173 and 179 in their yield forecast right now, but we're not able to go count, ear count round. How many round are we counting? Obviously length, we're far ways off from that, but we really don't have a cob size to measure. So we're going off of expectation of tonnage of a crop, and that's impossible to measure right now. So all the analysts, everybody, ourselves included, that are trying to outguess this are trying to do the impossible. So the realization is, let's go back to home. And for USDA, that was 490 corn. I think if there's one thing we can kind of agree on when we look at the foundation here, is that when you look to carry out, we're kind of in that 1.8 to 2.4 billion bushel crop. And any way you spell that, that's not $6 bullish corn. That's not $5.50 bullish corn. That might be $4.50 to $5.50, but that's the range we're in right now. So I think we kind of hover into that expectation. For beans, on the other hand, I think that's where the bull disappointment was this week. We come out a big report. We hit 1391, got a market that maybe can blow out to the top side and beat that recent high that we've had. And now we find ourselves down to about 1316, 1370 as we work towards that closing segment. And I think that's where the variation comes. But let's not forget, the hot, dry weather as it impacts beans is more of a July-August story. So this book is yet to be written. I'd say we're kind of halfway through the book right now in the bean market and have a lot of volatility to come in that market. So be careful here. We've got a VPOC at 1304, and we've really got the 200-day moving average that we went through today at 1433. So I really consider this 1304 to 1433, 1333 to 1304 area. That's really going to be the area of key significance here. If we take out 1304, Jesse, something big is happening here. Otherwise, I'd look for support into this range.
Well, and to those points as well, you mentioned the top side in corn of beans, and I think that comes back into play. Maybe not necessarily chart resistance, but that psychological level with beans. We couldn't break through 14. Yep. Corn, we couldn't. We did break through 5 yesterday or Thursday, and then we fell back below it. So it has something to say about psychological levels in these markets as well, Jim.
Absolutely. And I think it's kind of a settle in until you get a new piece of information. And, the old saying is, we go up on the escalator, down in the elevator shaft. Well, go back and look at 2019 corn, go look at what, Dees corn just did. And you see that, and there's a lot of references within years that you can see that progression up and then just the takeaway. And the same thing for beans. The difference in beans is we may have that progression, of another wave higher yet. Because again, right now, if we can take out 1385, you start opening up price counts of 1440, 1502, and 16. I'm just going to peek at the sheet because I haven't been quoting that higher price count, 1654. Those are the price counts that exist here within that market. If we can start to build out, have a little issue, start to see some demand come in. But as we talk about settling in, great, we settle in on price. But that demand sector, we need to feed this bull. And this whole demand sector continues to be a major issue, in our opinion, for this market. And when we get export sales today and we're talking about, great, we're on the upper end of expectations, but that upper end is dismal compared to what we saw in the past. That's a concern. And when we look out to 2024, we are lagging pretty significantly behind what we typically have on the books for a 2024 market year that does not start until September 1st. But again, we tend to accumulate those sales. And when you don't have that push, it's easy for the bear to hit the sell button and walk away here for a moment.
Well, I'm glad you brought up the demand picture and export sales because you are right that demand, we need to see more of it. It's ugly. It's been ugly here for the last couple of months. And, U.S. commodities are just more expensive than our world competitors. I know export sales we saw on Friday, 16.5 and 21.8 million bushels respectively, I believe, for quarter beans. Near the top bit of expectations, but still, we got a ways to go here, Jim. And I know, at least in the case of corn, you got that big South American crop, that Safrita crop coming online, but, their basis is rising a little bit. With U.S. corn coming down, maybe we'll get a little more competitive, but man, oh man, that demand picture, I just don't know. I don't know what it's going to take at this point, Jim.
At this point, it's going to take the Fed taking their foot off the pedal to some degree for investors' attitude. To me, I think we get caught up in exports and those are all huge. But let's not forget the biggest segment is the investor. Both managed money and index funds have hit the sell button as inflationary measures increase, as the Fed has started attacking. So unfortunately, I think we're 6 to 8 months off from seeing that ultimate low price and the start to build out into a more, what do I want to say, sustainable market here where at least investors are coming in with some attitude. Because yes, the managed money and index funds tried to buy off this weather, but they were not pushing a major. If we would have pushed a major, you would have seen a big influx of this money come in, and it wouldn't have stopped at 630. The difference is they're so skeptical of what the Fed's trying to do, and the hawkish tone that we saw the minutes even yesterday just kind of brings us to a consensus that, hey, 2023 is going to still round out as an inflationary fight. We might see 2 more rate hikes to come is what we're being warned of. And until we're past that, that's step one. Step two then is to see a drop in the dollar, which maybe today is a start of something there. But to get that dollar back under 100 could be a huge helper there. But really, point three is just pure quantity. It seems to be that our friends are the one that are buying from us. And what I'm going to call people that maybe we have some sour relations with right now seem to be the ones that are not coming to us continually. And China's the big gorilla in the room. If they all of a sudden come in with some focus in corn and beans, that'll change the spectrum. But they're the ones that take us from what I'll call 400,000 to 600,000 metric ton in sales up to 1 million metric tons when they come in here with volume to buy. So it's going to take better demand, and it's going to take some improved relations. And unfortunately, with the semiconductor issues that we've got in the backdrop right now, and we seem to be fighting with about China, this is not improving in the near term.
Yeah. And of course, to your point, China is that big gorilla in the room. And I know those tensions, U.S. Treasury Secretary Janet Yellen arriving in Beijing on Friday, trying to ease the tensions, but it seems like it's going to take a lot. So obviously we got to think about that Chinese demand and when or if it does come back. I would presume it does come back, Jim.
Well, and I think it will, because if you look at their exchange rate now, I mean, they've seen their corn price actually on the highs as we speak right now. So that progression higher has been impressive over there. So again, what it takes is this market to find out where is demand going to show up. And that's when you start to see that better support area. I don't think we're too far away, but again, it's just, that's what it's going to take. And then all of a sudden you'll start to get some people excited. And that's when you see your bounces back to 535, 550, possibly as high as 570 in corn. But I really think those are the key resistance areas here as we work ahead.
We're being joined today by Jim Emter with Van On and Company here on Market Talk. Jim, let's touch on wheat real quick. Busy week in the wheat market. We saw KC wheat kind of all over the place. Spring wheat, I'm hearing a few concerns with some quality issues with some of this dry weather that's come into the northern plains, but overall, this wheat market, I know it's always it's tough to trade wheat, but what are some things you're kind of watching in all three classes right now, Jim?
The value area. So if we talk KC first, that value area is really below $8 right now. That's where the bull has some substance. The closer we get to $9, the more sellers we run into. And it really takes getting past this harvest time frame. I mean, I've got a client down in Oklahoma I just got off the phone with here about an hour ago, and his comments were, Jim, this is a not great crop. And he said it in that term. Half of what they typically look. He wanted to talk to some more country elevators, but that's great. We got a half-baked crop. It's not as good as people expected. We knew that was coming, but where is the demand? We can continue to talk here all we want about production drawdowns in corn, production drawdowns in wheat, but it needs to start getting to be more obvious to traders that it is the demand that'll ultimately drive this market. A lot of people want to come back to 2012 and talk about that being the biggest market in history. Let's go back to a market that some of my veteran friends around the industry are talking about and saying 1973 on what Russia did there in wheat is the biggest market, the biggest surprise, the biggest demand market we had. And it drove corn price, it drove wheat price substantially higher on a percentage base and ultimately led to that. And that was driven by demand. The reason 2012 stuck out as a rally, it was not only a production concern, but we had demand behind it. What we lack right now is, even if we take the yields down in corn, even as we take the wheat yields down, we lack that demand push. And that's why when we start seeing uncertainty about a potential nuclear issue in Ukraine or Russia, that gets the market excited. Wheat runs 54 cents. Why? Because that could bring potential demand to the market. Now all of a sudden it fizzles out and we're down 25 today. We don't see a major, issue there yet. But these dynamics over in Russia, Ukraine are the biggest impact that we potentially have to U.S. getting business of wheat. And until we either see that business or we see an issue that could bring the business, what we get for rallies, Jesse, are limited until we see those develop. So again, I think we need to start moving away from the production side. We know what we've got there and start really focusing on demand and be ready to react, because I think that's what the great traders are doing right now in the wheat complexes. As for Minneapolis wheat, we have issues here. There are issues south of I-94 where you're going to hear people say the late planted wheat looks great, but the early planted barley and spring wheat right now is between ankle and knee high, headed out, and might yield anywhere from 15 to 28 bushels. That's what I'm hearing. So anything pushed early, planted in the mud, there's issues there. Anything that was planted later could be 50, 60 bushel. And that's the stark difference of that. So we've got to try to sort that out. We should have a wheat quality tour coming here in a few weeks. That could shed some light onto that. But at least for right now, we're stuck in the tug of war between what was planted early, what was planted late, and how big a difference does that impact demand, but our supply. But the demand issue is ultimately what's going to drive us on getting up towards $9 in the spring wheat and KC wheat versus the difference of trading sub 8 for times if that demand does not show up.
Well, and with wheat being such a world market too, one other thing that I just think is maybe on the horizon here, we think about U.S. weather all the time during the summer, but the Canadian prairies getting warm and dry, the EU getting warm and dry. We already got the tightest stocks in 16 years.
Yep.
I mean, Jim, if some of those areas that we aren't paying attention to, if they get warm and dry and affect crops there, that could also kind of help this demand picture as well, Jim.
It really could, Jesse. And that's why if I've got an order of markets that can bounce here, it's soybeans, then wheat, then corn. And the reason for that progression is obviously the USDA report beans and the crush push that's coming here domestically in the U.S. can make up a lot of ground there for beans. The wheat market comes back to your component. If we come in here and we take China ending stocks out of the world carryout number, now we get people's attention. But there's a lot of people that don't know any different that'll go say, well, our world carryout's adequate. So to your point, Jesse, we don't have as much reserve as the market wants to believe. And when you start talking about the issues in Canada and EU, again, that's a potential wave, but we're not going to realize that until when? January, February, March, when they move their initial product out. Because again, it's not like the EU or Canada's not going to have a crop, not going to have some export. So we got to start putting some time frames on when this market can kind of come into play. And that's why I like looking at this and saying, generally, we are a strong bean export market here at harvest. And usually the elevators in North Dakota get a little furly on trying to take spring wheat and corn and bean harvest. So that demand push from millers as well as the circumstance of exports, I really think come in that Jan, Feb timeframe. And I think that's also when the Fed's finally going to meet their mark on this inflationary. So that's when we can start to maybe transition to say, all right, what do we have now? You can grab onto carries. We've got good carries in corn. Redeveloped carries in corn, I should say. You've got a wheat market that's pretty flat, doesn't have great carry. Hopefully build into those and producers can take advantage of those. But that's the foundation that we want to try to live into, is starting to quantify when this demand structure can hit for corn and wheat and when that potentially can move, because Europe's going to have a crop. Canada's going to have a crop with the start they've had. Canada's dealing with some hot issues as well, just not in their core areas. So as we look at those I said China there, dealing in the core areas. When that all comes together, yes, it can amount to something. But when, I think that timing is going to be a little later. So.
Awesome thoughts. Awesome analysis there. Great stuff, Jim. I got to get just a couple livestock thoughts from you real quick. Really solid day in cattle on Friday. Nice recovery there to round out the week. Hogs, front month hogs, a few triple-digit losses there. Maybe felt like, we got $100 hogs. Maybe we took some profit to round out the week. Overall, any thoughts in this livestock protein sector at all, Jim?
Yeah, so let's come cattle first. When I look to feeder cattle, live cattle, as a tech trader, I think first and foremost, we got to look at the charts and ask what is happening here. We've got feeder cattle, live cattle, both trying to progress into highs, and we've got 7 guidelines or rules that we use to technical analysis. One of those rules is watching RSI for negative divergence versus price. And what we're seeing right now is we're seeing higher price with lower RSI develop in this market. That's a warning flare, especially when we're into 3rd and 4th price counts on feeder cattle, live cattle, to say, hey, hedgers, you better be managing some risks here. We think we're into the upper bun of the cattle market. We think seasonally we can see this progressive pullback, but more importantly, I think the Packers are due for a little rug pull here on the market, meaning they get current, they pull the rug, and then potentially set themselves up to buy into what potentially could be a pullback down maybe 10, 15 bucks within this market. So that's what we're a little bit concerned of. That doesn't mean you need to conquer the world. Just keep those risk management measures in check. Hog markets are no different. If you look to your retracement counts, the hog market retraced back to a 62 to 78.6 retracement, and now we're struggling with that area. I think that's the biggest thing in hogs is, are you going to be an extension guy here? Or are you going to be a retracement guy? And I think just even though we're getting tighter on weights, tighter on numbers here a little bit, we've still got to look to the economic scope and say, I don't think this is a blow up, take out the high type market. So I think you've got to zone in here and say for July, 102, 103 was that retracement count that gets you into those upper counts. You need to be doing some marketing here and risk management, because that was a bloodbath that we watched on the way down. And now we've got retracements back up. Use those to your advantage. I think we're into some resistance area for the meat sectors. We're past the key demand season for grilling. You've got extreme heat in Texas that's going to keep people inside. You've got to start to look to these markets as risk management measures.
Jim, great stuff here today. We appreciate the time. And I know if folks want to reach out and talk markets with you and the team there at Van On and Company, phone call, website, a lot of great ways to get in touch with you, isn't there, Jim?
Oh, absolutely. www.vanonco.com, VANAHNCO. Check out the website .com there. And if you give us a call, 800-648-5494. We'd love to visit with you. Again, we try to really run loose on pressure tactics. So if you got a question, hit us up with it, and we'll try to step you through this market.
Well, we appreciate the time. We'll have you back on the show again real soon. Jim Emter with Van On and Company. Thanks for joining us, and have a great one. We'll talk to you soon.
You guys too. Thanks, Jesse.
And that's going to do it for the show today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great weekend.